Hey, good afternoon, everyone. Hope you all had a great weekend and a profitable or exciting market day today. Hey, Tim. Hey, Spider Monkey. It's great to see you guys. So let's take a look. We'll do our normal afternoon procedure. Hopefully, well, it's only been a few times, so you guys will get the hang of this. But basically, we're going to check out our liquidity environment, our VIX environment, our market breadth, and our, well, market breadth is the third, are whether or not we see buying happening inside of the markets. So S&P 500, it basically just continued to chop sideways. We came and touched that EMA 8, went up off of it. Could we call this a bounce off of the EMA 8? We can call it a touch. I wouldn't really call it a bounce yet. We haven't gotten a direction. We could just chop sideways for a while here and maybe even just keep on chopping until we hit that EMA 20. That's pretty unusual. It doesn't really normally happen that way, but you can see we chopped here on the EMA 8 for a while before we broke down right here. And right here, we chopped through the EMA 8 until it broke down and then went to the MA 50. So there are a few times here opposite. It chopped for a while, then went up. And so it doesn't have to be a pullback. It can just be a consolidation here, crossing several moving averages. So that would be a lot more non-directional, like this right here. So here we chopped across the EMA 8 and EMA 20 for a while before those two started to separate. So we could get something similar this time where the EMA 20 catches up to the EMA 8, or we cross that EMA 8 for a few days before we either pull down or pull upwards. Those are acceptable. That would indicate a very strong market, but a normal market would come and pull back, and actually a healthier market, something that is geared to move even more for the second half of the year, we would expect that pullback more so than this just grind upwards. Although this last week we can't really call it a grind upwards. It's just a chop sideways. So overall, I would say this market, at least today, wants to just keep on going sideways. Tomorrow, at the very least, we do have some catalysts coming up, CPI. Tomorrow at, I believe, an hour before the market opens. Yes, an hour before the market opens. So we'll want to watch out for that, see if that introduces some volatility. If we get a bad print or if we get a super good print, then the market can move. If we just get consensus, then we're probably not. And you can see that consensus is that we're probably seeing a little bit more inflation, which is kind of interesting. But as long as the number is right around that 2.9, the market's not really going to care that much. Hi, Rick. Or is it Richard? Hi, Richard. Sound is very echoey. Thanks for letting me know. Let me see if there's anything I can do about that. How's that? Did that change anything? Hopefully that's a little bit better. No. So if we look at our VIX environment, it did go up even though the market was flat. So not echoing for you. Okay. Oh, okay. All right. All right. Thanks. So this is not great that the market chopped sideways and then we went up. Or actually, I mean, technically the SPY went up a tiny bit and VIX went up as well. That's a diverging behavior. So I definitely want to take a quick look at VVIX, see if that's indicating anything. So if we pull back and remain under 20, that's super ideal for continuation and buying the dip. But more likely, we will see it break above 20 and maybe stay there for a couple days, just like we did over here, just like we did over here. This was an exception. That was an exception. Here, just one day, one day, one day. So a couple of days above the 20 is not going to be terribly concerning, but we want to see if that's in the forecast. So if we look at VVIX starting to curl up as well. Okay, so we'll want to see if that continues. Tomorrow will give us a much better understanding of that. Today is sort of like, oh, we'll watch out. This might be happening, but we'll get a much better and clearer picture tomorrow. So for now, we're still in a buy the dip type of environment. And we would want to see specifically, we would want to see those more defensive sectors still. So let's take a look at our ratios. So what did silver do? Silver was the really interesting one on Friday, and same with commodities. So silver backed down a little bit. So that was a huge move. So pull back to the EMA or these levels right here, this breakout level is perfectly normal. So we're not seeing a giant run in silver. How about Bitcoin? That was a big mover also. So Bitcoin continued its move up, but pulled way back. Looks like there was some profit taking over here. We got significantly higher and then pulled back until we're only up 0.82% versus the high was probably like 4 or 5%. So we'll want to see those Bitcoin treasury picks that we had earlier, and we'll want to check on the materials and the utilities as well. Let's take a look at our ratios. So let's look at gold, silver. Gold, silver, just flat. It did go down, but it ended up flat. If we look at our SPY GLD, SPY divided by GLD, flat. That's same as before. Let's just look at gold itself. Gold was very flat as well. Let's take a look at treasuries. Okay, so outperforming treasuries. So we probably had a drop in treasuries today. Not much of one, just a tiny baby drop in treasuries. And then let's take a look at oil. Okay, so pretty much flat. How did oil do? Oil, yeah, it's getting stopped out at this MA50. So it's getting more volatile though. You see that? These bars are starting to get bigger than over here. So oil might move, right? If we see that expanding volatility, that is starting to move into more of like a regime. If this was the SPY rather than crude, then we would start to see the VIX. We would expect it to be hitting the 20 or exceeding 20 right now. So we're seeing expanded volatility right here in energies. I'd be careful with them if you want to. They can make great one overnight trades or day trades, but I'd be very careful swinging energies at the moment. And then let's take a look at our breadth. So still very high up here on the 50s, climbing a little bit higher on the 200. And now we're about 17 apart. That's still pretty healthy. I wouldn't get too excited about that. Okay, so our sectors are going to be very important once again. I should probably be looking at more short term. Let's go look 1 month. Semiconductors, home builders, tech, defense, mags. Well, that's a reasonably good stack. How about today? Defense, biotech, communications, financials. A little bit more of a mixed bag today. Yeah, but still on the whole leaning more speculative than not. So one thing that I haven't shown you yet was taking a look at gamma levels, especially on a weekly basis, to kind of get a clue of where exposure is, where people are making bets, large bets inside the markets, and where does the market maker have exposure that might force them to participate and support certain levels. So let's take a quick look at that. That won't move. There we go. Okay, so I'm more interested at the end of the week, so that would be the 18th. All right, so that's pretty interesting, right? We closed at 625. There's quite a bit of exposure up here at 630, and there is some exposure up here. There you can see that there's definitely interest all the way up to 640. That is really lofty for the end of the week, which is probably why you only see a very tiny bit of exposure there. But 630 is doable by the end of the week, and that is definitely where things are stacked up. Far more favoritism to the call side than we have to the put side. We can see that with these gauges right here as well. And then that's interesting. Yeah, we've got 620, 630 as the major levels for this week. So we're smack in the middle of it, which means that we could go back down, we could go back up, but seeing all of that exposure to the positive side at 630 and above, you see that we don't have that same thing at 620, although we do have negative exposure below 618, at 618 and below. So these are going to be very important levels. What it indicates to me is that if we break through 620, it could be a fairly rapid fall. And if we break through 630, same thing, it could be a very rapid rise. But I'm not really expecting that. We've got some major chop in the market right now. And we've seen that over the last several days. And right now, we don't have a catalyst that might send us one way or the other. Could CPI send us 5 points up or down? Probably not by itself immediately. It might take a little bit of time if the market catches on that, hey, there's a really good chance that we're going to get a rate cut or not, that we have a bit of a surprise with rates on Friday. If we look at FedWatch, we can see that priced in September, we have about a 60% chance of a rate cut. The market is pricing in 60% chance. Currently, we're in the 425, 450, right? So the market is pricing in a 60% chance. But if we look previously, it was higher. It was a little bit higher. Okay, it was at 60 in the 60s. So a little bit of a move right there. And then if we look at July, let's see if that changed. July didn't change that much. So if we get something that causes us to have more certainty in September, like if this was to go up to in the 70s or 80s or even 90s, then that would be a major catalyst in the markets. So we just need to see how that CPI plays out. I don't think it's going to be that different. I don't think we're going to get a shock move, in the S&P 500 or in the CPI number that's going to cause people to suddenly think we're for sure getting a rate cut or not. There's still too much uncertainty with tariffs. I think right now, in the coming weeks, the major catalysts are actually going to be earnings and not so much data, economic data. Any straddles or strangles that I like to use for earnings? Earnings, straddles, and strangles require a lot of research in order for you to gain an edge because earnings events are volatility events. They they will force you into a different volatility regime. So today we took a look at VIX and we said, okay, we're in a low volatility regime, which means buy trends, buy pullbacks. But if I see an individual stock that has earnings, say tomorrow, then they're going to be locally within their own world, they're going to be in a high, well, most likely going to be in a high volatility regime, and not even mid, a lot of high, especially if it's tech, especially if it's highly followed and a whole bunch of people are trading it. Maybe not if it was a blue chip. If it was a blue chip, it might just be in the middle volatility regime. But for most stocks, you're probably looking at a high volatility regime. And high volatility destroys everything else. Nothing else matters in a high volatility regime. It doesn't matter what your technicals are, doesn't matter what your fundamentals are, doesn't matter. What it means is people are just being hyper emotional, hyper emotional. So if you can think of someone who's having a panic attack or someone who's just hysterical, you can't logic with them, right? You can't reason with them. Or if someone's having a panic attack, you can't say, oh, it's all right, there's nothing wrong, like, everything is fine. You can't say that because they're not reacting to the actual situation that they're in. They're just having a panic attack. So, so it's the same way in the markets. If we see a high volatility, that's basically the market having a panic attack, or that individual stock is having a panic, the market for that individual stock is having a panic attack. So you can't trade it the same way you would normally trade it. You can't trade it logically. You got to trade it as like it's an emotional roller coaster. So straddles and strangles are saying, hey, I think that it's going to have a huge emotional reaction, and selling or shorting a straddle or strangle is saying, hey, I don't think it's going to have a huge emotional reaction. The problem with that is that you technically have undefined risk on a short straddle or strangle. You can very easily bust beyond. You can end up losing more money than you have in your account if you short a straddle or strangle. So because it's a highly volatile event, then you've got to research it very carefully. Basically, it's sort of like, oh, Susie just broke up with her boyfriend. How do I know if she's gonna freak out and be a wreck for the next 2 weeks, or if she's gonna be, oh, that's totally fine and be cool? I I don't know that unless I know Susie very well, right? So, and how do I, even if I know Susie really well, I might not know. If I haven't seen her break up with her last 10 boyfriends, then I probably don't have a good idea of how she's going to act after breaking up with this one. So I've got to study the situation. It's like, okay, well, what are her past relationships like, and how into this guy was she this time around, and how long were they dating, and things like that. So that's the analogy. If I'm going to trade earnings, then I need to dig in and say, okay, what were the last 10 earnings like, and how did we react, and what was the situation? Was it very similar to now? And how much interest was there in this stock before and after, and what are the things that might trigger me higher or lower, all of this stuff. So we've got to study each individual name very carefully, and I haven't done that. And so I can't comment on any specific straddles or strangles because I simply haven't started looking at earnings yet. I know it's coming up, but usually I won't start paying attention until I see the major financials coming up. So is there a way to see it 1 week at a time? FinViz. So if I see this week
and sort by market cap. Okay, so we've got TSM, JPM, Netflix. So we've got a few major ones coming up this week. Could be time. Could be time to start paying attention. We got the bank, Citi, JPM, BlackRock. Yeah, we're starting to get into earnings seasons this week. I'll take a look. I'll do a little bit of research. Yeah. So let's see. Am I looking at gamma pockets on TradingView? I use my own software, but TradingView they don't have options data. So the only way you could get gamma pocket levels is if someone was feeding options data in the background and then using some sort of scripts to draw it onto TradingView. So no, I don't use TradingView for gamma pockets. Am I almost done with making this program available to you guys? I am in talks. I am in design phases with developers because I can't do it by myself. I'm not a web guy. I'm not a web developer. Like I can make software that's good enough for me, but I can't make like software that's good for the masses. So I'm in talks with developers. So we'll see how quickly it goes. Love when you send the high target gamma prices in the market. Oh, good. Yeah, they've been really good, right? Today we talked about SPY 625, and I said it might bounce, it might be sticky, and then it ended up being pretty sticky. So today, how much time did we stay within that 625 vicinity? It was a very long time, right? Basically all afternoon, except for a minor dip over here. And then that high at the last minute was 624.99 before we pulled back to 624 or whatever it is, 80 or whatever, wherever it closed, 81, 624.81. So those gamma levels have been very, very good. Okay, when I send the SPY gamma levels in the morning, the strike that has the largest bars is where we can close for the day. It is a pretty good indicator. What it means is that there's a huge amount of interest and a huge amount of exposure for risk exposure for the market maker. So it will generally act as a pretty strong magnet. So either prices will go there and bounce off of it because something else happens in the market, or prices will go up there and stick. It doesn't have to happen, but the likelihood of it happening is very high. What about calendar spreads to take advantage of the IV crush for the front week? Yes, you can do that, but it requires a similar amount of, it requires a little bit less research than if you want to do a straddle or strangle on earnings, but it still requires additional work. You can't just say, oh, Microsoft has earnings, let's do a strangle, or let's do a calendar to try to take advantage of that IV crush. You still have to study it because your risk reward on those trades becomes extremely important, because if you put on a calendar, it doesn't have to give you a really great risk to reward. So you could end up paying a whole bunch for that calendar, like at $10 per lot. And then your risk reward could just end up really, really sideways, and then you'll be a net loser if you keep on doing that. So you still have to pick them fairly carefully. You still have to do some analysis before you go in and choose to do calendars ahead of earnings. Okay. 624.51 now, yeah. So we would want to see how, for example, we could take a look at gamma where, as of today's close, where gamma exposure was for tomorrow. But that picture changes wildly once, well, it doesn't have to, but it can change wildly once the market opens. So right now, even at 7:15 tomorrow, we already have 6:30 in focus. And then we have a much more uncertain picture here. We have a huge amount of exposure to the downside, many different strikes, and same thing for the upside with the most concentration at 6:30. So this doesn't give us a super clear picture, and this picture will almost guarantee change at the open, and then almost guarantee change within the first half hour of the market. So, but what is interesting though is that 6:30 is there, and it's persistent across several expirations. So it wasn't there today. Today was 6:25. And then if I look at on the 16th or Wednesday, then it's still there, right? But suddenly we have a lot of exposure looking at 6:18 also. So people thinking about that pullback. And then 7:17, same thing, that 6:30 is still there, but we have a lot of interest in between 6:24 and 6:30 as well. And then we have some interest down here at 6:20, and then on the 18th. Just definitely 6:30 is there and 6:20 is there as well. Okay, so and this is to be expected because the further we go out, the less certainty we have. And then when we open up the morning of, we have more certainty, we have more information. Catalysts have gone by. Markets, overnight markets, or Europe and Asia has gone by, news has gone by, and so we get more and more certain. But what's interesting is that all week long, we see 6:30, and for most of the week, we see 6:18, 6:20 as well. So what that indicates to me is that there is, if we just put those lines on, and we do 6:30, okay, so if I do 6:30, yeah, that would be an all-time high, but it's not like the market is screaming higher. And then if I do 6:20, okay, same thing. Oh, yeah, it's lower and it's technically below the EMA 8, but it's not really all that significant. So for now, the way that the market maker's risk is positioned is favoring a chop, because they will have to kind of hedge themselves in between these two levels. So it's going to be very difficult for the market to get beyond those levels, because no matter no matter which direction we move, the market maker has to kind of hedge in the opposite direction as well. So they have to hedge in both directions. So basically that they're going to be muting any price action with their hedging. And I don't know how much total exposure they have, but if it's a significant amount of exposure, then that is going to be, the more exposure they have, the heavier of a muting effect that is. Okay, so that's why the larger concentrations of gamma on those strikes are more important than the smaller ones. But what we see is a lot of the week, the gamma exposure is fairly even across many strikes. It's just that 6:30 is a more obvious level. So I'm not expecting this could change, but as of right now, looking at that gamma picture, it looks like more chop sideways. Yeah. Okay, so this is good. You guys are bringing up some good stuff today. And all of this helping us get a better picture of the next few days, which is the point of the afternoon. It's not today trading or tomorrow trading. It's over a slightly extended time period. Okay. Don't you want volatility on strangles so the option moves nugget or lower? I think you mean higher or lower. Volatility helps, it makes it more likely that you will move outside of a range. Yes. It does not guarantee that it will stay outside of a range. So you need volatility plus directionality to be more sure that it will go outside of a range. But on the strangle, you're fighting that market maker because that market maker is expecting a certain amount of movement as well. I think one of the earnings was JP Morgan. So we can take a look at JPM. So if I'm looking at this July 18th, that market maker, a rough estimate you could say is looking for $10.21 movement, either up or down. So if you buy exactly this 18th expiration and it ends up moving only $10 instead of $10.20 and you bought a strangle, you bought both of the you bought this, or you bought the 287.5 strangle, which cost you basically $10, then you don't make any money, right? You lose all of that money. So if it moves $11 either direction and stays there and closes there, then you would have made $1 out of all of that. So you make 10%. That's not really great. So for the possibility of losing $1,000, so you need to pick those strangles very, very carefully. And so you might consider, okay, well, I won't choose my expiration so close. Maybe I'll go out 1 or 2 weeks to give it space. That way, if it doesn't go as beyond the market maker's expectations, then I don't lose 100%. But if you do that, then you're talking about much more expensive strangles, right? So this would be about $14 per lot. So that is 40% more expensive than if you went out to exactly the expiration. So either way, you're fighting that market maker because the market maker doesn't want to lose money, right? So they're going to price it appropriately. Just want to say that I was strictly a toss user and watching you use TradingView more and more, you're really liking it. Yeah, I started out looking at all my charts on Thinkorswim as well, but the ease of viewing and manipulating the view into the way that that helps me visualize it better is way easier on TradingView. Would I consider entering a vertical trade with VIX climbing? That's an interesting idea, Tim. Absolutely. So let's take a look at VIX. Would I consider a vertical? Well, I would have to see if I could get paid something reasonable, because for sure if I go at 15 and higher, that's not going to pay me anything. So I'd have to be willing to go at 17 or 18 probably for that to become interesting. And then what time period do I look for? To be safe, I would probably be looking at least a month. So if I go out to August 15th, oops, the VIX expirations are going to be different. They're generally Wednesdays. So if I go out to August 13th, then I could do see what would a 16, 17 be. You see that though? They're zero bid. So the market maker probably pulled all the levels at the close today. So that's not too helpful. Yeah, across all the expirations. Yeah, so fortunately I can't properly evaluate this right now. But good idea. I mean, it's worth exploring and worth looking at. Yeah. Okay, so let's take a quick look at we started looking at the breadth, take a look at the sectors. And I'll just take a look at using the charts. Defense really moving, okay, which was great for my directional trades in my programs. We closed them out at profits. But that is a kind of aggressive move, ITA. So that is a breakout. So even though this is not perfectly vertical, but it is, I guess we would draw a channel breakout. I'm not a big fan of channels, but this is a channel. Okay, so channel breakout. So that can probably may move aggressively and then come back and retest. Or I drew the channel wrong and all it did was go to the top of the channel and it'll come back and retest. Okay, so I'd be a little cautious with defense at the moment. Biotech not looking great. Communications showing some signs of life, a little bit of a bounce right there. So you could say that technically that was a reversal of the short-term trend bounce moving to match the longer-term trend. So that MA50 being the longer-term trend. And you can use price or EMA 8 in this case, where the EMA 8 did curve upwards. I would, tomorrow, I would watch very carefully. If it continues to move upwards, then I would be reasonably comfortable going into communications with the caveat that I know that there could be a pullback imminent in the markets. So I would just be very careful. I would look at my reward risk ratios in my trades very, very carefully. And then where's my, there we are. Financials, we said was kind of interesting last week, and it did start to move up today. Industrials, more of a continuation of a trend. Yeah, that's a strong trend right there. Probably wait for some sort of pullback or consolidation. Utilities, again, more of a breakout, but this is if we wanted a safe sector to rotate into. If there is a pullback, XLU would, utilities would definitely be a candidate. Mags continuation of trend, but very, very low volatility now. So it's kind of tapering out. We want to see some life come back into it. XLK baby pullback. Healthcare in the dumps. Gold just chopping sideways. A little bit of a pullback in materials. So it looks like pretty much the same sectors we might be interested in. And then that Bitcoin. So we could look at the cryptos again. So I would just look at the same, oops, XLU. Yeah, XLU breaking out, but resistance right here. Basically where the high was today. Today's high on XLU, it hit that resistance. So I would be looking at XLU, XLB, maybe XLF, and XLC. So let's take a look at our list from last week, see if anything interesting happened in any of these names. VST, not ready yet, still chopping sideways. NEM broke out, right? So that's very, very nice. So you could go into NEM, or if you weren't already, I was in an NEM. So I actually took profits because I'm not looking for long swings in anything related to metals or gold until I see a trend develop in gold. Right now it's just chopping sideways. So that's why I took quick profits on NEM. FCX, pullback. LIN, chop sideways. Vol, consolidating. Okay, so this could be interesting. It's just following that EMA 8. So it could be interesting once it breaks. And then PPG broke. So I wouldn't be interested in PPG anymore. And then the cryptos, we looked at MSTR. That one's really going. That one is stronger than Bitcoin, actually, and very parabolic, though. That's I would definitely wouldn't chase MSTR. Mara, huge movement upwards and then closing all the way back down. So a huge amount of profit taking happening in Mara. We'll see if that trend can. So far though, the trend off of the lows is still up. So I would watch carefully on Mara. But if you weren't in a position, you would just wait, just keep on waiting for a pullback. There's no rush to get into Mara. GLXY starting to move, although it made a high versus Friday, and it did close above. Yeah, so this is looking okay. I don't like the wicks so much, but it is moving. And then we've got Hut very slowly moving upwards. And then JPM. What do I have JPM here? JPM was a financials. Yeah, financial was moving a little very slow, very slow short-term reversal to match the longer term. I would wait for a little bit more confirmation before I went into something like JPM. Maybe a gap fill right here. If we can fill the gap and then keep moving higher, then you've got a chance to match the highs right here and then see if it breaks out. Oh, thank you, Naples fan. Yeah. Okay. Okay. So let's take a quick look at the new sector, which was XLC. Okay. XLC looking like a nice little bounce off the EMA 20 so far, at least. So I would definitely wait till tomorrow and see if we continue that. But tomorrow entry into XLC, if you see that moving or a strong stock in XLC, could be a very interesting trade. So let's see what is in XLC. A pullback on Netflix. Take two, bounce off of, is this a 50? Yeah, bounce off 50 into resistance at other moving averages. I would wait for take two. Meta chopping sideways. Para, that's interesting. And Warner Brothers, both of these very strong. So kind of content creators, although Netflix is down, but Paramount looking very good. Warner Brothers, very strong trend. Live Nation looking kind of interesting. News Corp, maybe if it breaks out, it would be more of a breakout candidate. Huh, so it looks like really just those. I'm surprised that so few look good given the entire sector. So really, unless take, come on. My mouse is not responding. I look at those Paramount and Warner Brothers is carrying XLC, which would be really surprising. Let's take a look. Oops. Meta, Google, Netflix. I'll take a quick look at Google. CMCSA, Charter. Google is looking good. Breakout today, bounce off of the MA200 right here. And at the same time of bouncing off the MA200, that the EMA 8 flipped around to match the longer term trend. Google is looking good, but would it cause XLC to be at highs? Is it all-time highs? Very close to all-time highs. I'm surprised we're not seeing more good-looking stocks in XLC. The best ones were Live Nation, Warner Brothers, and Paramount. Live Nation, strong move, very strong move today. Paramount, also very strong move today. Is there news? Nope. And then Warner Brothers. Warner Brothers just has been strong. That's interesting. Well, Warner Brothers definitely you would want wait for a pullback. Paramount would have been better in here. Basically Thursday, maybe Friday. You can see that EMA 8 curved upwards. So you totally could have caught Paramount on Friday if we were paying attention to this change in the EMA 8. But right now I wouldn't chase into it. And then what was it? Live Nation. That's interesting. I would wait on Live Nation also. Less than average volume, huge price movement. That is normally the opposite of what you want. Like this is more like what you would want to see. Huge volume bar, tiny price movement. That is pent up energy, pent up demand. This could fizzle out. So I would pass. So I would wait on XLC. I would wait on it. Doesn't look like it's a great candidate at the moment. Any idea for tomorrow's earnings? We're sort of already went over that. Is there a difference between Google and Google? It's just the class of shares. So Google is Class C shares and Google, I think Class A. Yeah, Class A shares. Yeah. So they should move basically the exact same. You can see if I lay the chart on top of each other, they're basically doing the exact same thing. Okay. Earnings for tomorrow. Well, first I have to see what is. So if I'm playing earnings, if I want to make an earnings trade tomorrow, then I'm looking at something that is reporting earnings on Wednesday. So we could take a quick look if we can find something really fast. But there's a few different, I have at least 5 different ways to play earnings, but some of them require you to do it like 1 or 2 weeks ahead of time. But on the day of, there's still multiple ways that you can do it. So if we say earnings on Wednesday, July 16th. And I'll sort by market cap. The really small market cap ones I'm not really going to care about. And then I will go for more recognizable names. Alcoa, is it really going to move that much? Probably not. United might. KMI might. Goldman, Morgan Stanley, Bank of America, all related and all reporting on the same day. So that'll be interesting, especially if they move in the same direction. ASML, semiconductors, and J&J. I don't know how much J&J, how much volatility J&J would have. So one way of getting an idea of volatility crush is just taking a look at these expected moves on the right-hand side per expiration date. So we would expect 32 to collapse not all the way to 23, but most of the way there immediately after earnings. And then eventually all of these will collapse down to roughly 19. So it's not that big. It's not that big of a volatility crush. So J&J would not be interesting to me because remember on earnings, well, if you're trading the day before, then you should be trading volatility. Okay, so J&J doesn't give us a lot of volatility change, so I wouldn't be considering that. How about PGR? PGR insurance, yeah, we'll take a look at that. PGR, same thing, not a huge amount of volatility crush, although it could be somewhat interesting. Okay, generally I would want to see at least 15%, but this is 11. Or especially if I go over here, okay, then we can say that maybe that's around 20. But the immediate crush that I would experience would be on par with maybe 9 or 10. Okay. So PGR, I probably gap. It's too, sometimes it gaps a tiny bit, sometimes it gaps a huge amount. So sometimes it doesn't gap at all. So it's PGR. Oh, this is matched, not PGR. Oh, that's interesting. So yeah, these are baby gaps. So if it's only going to move 1, 2, or 2%, 0.8%, 2%, 2%, 4%, 6%, and then what the market maker is pricing in is what is that? 9 divided by 247. 4%, 3.5%. Okay. And then how many times did we go above 3.5%? Not there, not there, not there, not there, not there. Yes here. Okay, I guess yes here. And then I can't see this one, but the next one. So I wouldn't be trying on PGR. Or you could try something like an iron condor, where you have defined risk and you're going to bet that it's going to stay within the market maker's range. But the problem with the iron condor is the reward risk ratio. So if, yeah, high probability it'll stay within the range, but if it goes out of the range, you lose way more money than you could have made if you were within the range, especially because you're playing the market maker's range. So unless you want to go tighter than the market maker's range. So the market maker was saying about 3.5%, and if you go in and say, okay, this was only 0.8%, that was 1.8%, that's 2.7%, that's 2.5%, that's 2.8%, I'll ignore the older ones and say, okay, what if I go in at 3% up and down rather than 3.5% up and down? Then maybe you can get a little bit better reward risk ratio, but it's probably still not that favorable to you. Okay, so this is the type of thing that I consider on overnight earnings trades. Nervous about trading? Yeah, I don't blame you because trading earnings is a very different beast than what you're normally looking at inside of the markets. So you have to control your risk very tightly. You have to control your allocation very tightly. And then you have to be comfortable with volatility of it moving up and down. So, and we're considering and we're looking at very different things when we trade them. Now, there's definitely ways to effectively trade earnings, but it's going to feel strange to you unless you consistently trade earnings. If you're used to trading for income, if you're used to trading like trends, if you're used to trading directionally, if you're used to using technicals, earnings trading is going to feel like gambling to you, and it's going to feel like very, very, very uncomfortable because you're going to the rules are completely different. It looks the same, but they're completely different. It's sort of like you play chess and you play checkers on the same game board, but the game is completely different. Do I prefer iron condors or time spreads? I would prefer either a vertical or a time spread in most cases if I'm only going to trade the volatility crush. So we looked at two of them. Maybe I'll look at one more, one that might have more volatility. So we'll take a quick look at Goldman, Morgan, and Bank of America, whichever one shows me good volatility crush first. So you see here, Bank of America, that's a 15, 16 immediately versus the less than 10 we saw on the other two. And then over the next couple weeks, looks like we could crush another 3 to 4, or another 8 to 10. Okay, so Bank of America would be a far better candidate than the previous two. If I look at Goldman 13, then another 4 or 5, and then Morgan is 15-ish, then another maybe 5 to 10. Okay, so Morgan or Bank of America would be my choice, and then it would just depend. I would have to do more. It takes time. Earnings takes time. It's not, oh, just look at something and then come up with a trade. All right, so Morgan and then Bank of America. Yeah, I have to do a lot deeper analysis, but it's potentially interesting, either one of those two, Bank of America or Morgan Stanley. And since they are in the same sector and reporting on the same day, I would only pick one of them. You can do iron condor on the market maker's expected moves, but then your reward risk ratio will be terrible. Right? At an institutional level, do they trade earnings or do they avoid them completely? On an institutional level, depends on what type of institution you're talking about. But the really big boys, they don't, they place their trade way before earnings, and they would hold straight through earnings. So if I was an institution at Goldman, then I started a buy campaign down here. Okay, and then I probably bought again right here, I bought again right here, bought again right here, and then would I buy again right here immediately before earnings? Probably not. But my average, say if I started in April, then all I have to do is look at an anchored VWAP in April. And let's make it, I need to make it more obvious. Get rid of some of these. Okay. So if I had a buy campaign, your average institution has an average price of 586 since the beginning of April. So this thing can drop like 150 and they wouldn't care. In fact, if it did, they would buy a whole bunch more right here. And if it flies up, then take profits. So that's how large and major institutions. They don't do the 1 day or 1 week trade thing. They they've they're banking on they did their analysis over here at the last earnings, and they started saying, okay, well, I think that this we should build a position in Goldman, and they started to all the way until these earnings, and they'll continue to. If it pulls back to their VWAP, their average price, they'll buy more. If it pulls back to reasonably close to their average price, like maybe over here, another area of support, they'll buy more. If it breaks it, then they'll probably take their loss. But the chances of them breaking, breaking, like if we're going down 150, 140 points is very, very, very low. And then if it goes up very sharply, then they start a sell campaign. I learned how to achieve daily target on non-earnings. Yeah, yeah. Earnings trades are because they come every quarter, right? So you don't have a lot of activity. So for most traders, then they will, unless you're specifically trading earnings or you're designated to specifically trade earnings, then they're like playing a game, right? They're like, it's sort of like going to the casino. Because if you think about it from an investment perspective, right? If I win, 6 out of 10 trades and I lose 2 or 3 in a row, I've still got to make 6 or 7 more trades for the statistics to start moving back in my favor. If I have to make 6 or 7 more trades, that's 6 or 7 more quarters. So I'm waiting almost 2 years for my statistics to play out for me. So it's probably not, so they're not putting significant amount of money in the types of trades that we're talking about right now. And so they're just fun. They're just for fun. And that's the way we should do it also, unless you're willing to wait 2 or 3 years for all of the statistics to work in your favor. Okay. Yeah. Yeah, we don't, yeah. Okay. All right. So we'll end it here. You guys, good discussion, good questions. And yeah, we'll focus on the trades that can pay you consistently and more frequently. Better and more efficient use of your capital. All right. That is it for today. We'll see you guys tomorrow. Have a wonderful rest of your evenings, and we'll see if our gamma levels for this week. Let me just draw them. I already have so many. Oh, I already drew them. Okay, we'll just keep them up there. Okay. And we'll see how those play out this week if we actually do get chop. So again, we look for what we can see in the afternoon, but in the morning, we have a lot more information, and then we redo our morning analysis. That'll tell us, so if the morning we say, hey, there's a huge downward pressure, then I would just completely forget about this 620 level, just throw it out the window. Okay, all right, guys, have a good night, and I will see you tomorrow.